Hello, everyone, and welcome back to Your Finance TV. As part of our regular monthly series with ACF, we have ACF Capital Pulse with Christopher Nicholson. How are you, Christopher?
I'm very well, Scott. It's great to be here, and thank you very much.
I'm looking forward to a little bit of exciting news coming out of this one. We're going to be talking about gold. Now, ACF published a thematic piece on gold back in March 2023. Christopher, tell the audience more about your gold price 12-month target at the time and whether or not you were right or you were wrong.
So it's a great question. It was a slightly scary year, I have to say. We were pretty brave with the price target. I think we published it was about $1,900 an ounce. We went out at 2,200 on the Bloomberg panel. I think we were second highest, which is always, slightly risky when you've got the likes of Goldman's, etc., publishing behind you. And in the middle of the year, we felt like, okay, this is not going our way. But in the end, we made it at 2,200 with just about a week to go before the end of the 12-month forecast. In fairness, we had thought that it would get there by the end of 2023, but it got there within the forecast. So, we were pretty pleased with that. It got very close at one point. We were $5 off. And we thought, we missed it. But actually, in the end, yeah, it comfortably got over the $2,200 mark. But as I say, with literally a week or two to spare.
Well, as the old saying goes, you're only as good as your last call. What is your forecast for the gold price for 2024?
Well, this is a good one. So there's been internal debate about this. It's been quite active, but we are going for 2,400, and we've got kind of good reasons behind that. We appreciate that most of the market thinks it's going to tread water, but then we went against the market consensus last time, more or less. And we think a lot of the things that were in play last year are in play this year as well. There are, of course, changes coming, but we think fundamentally a lot of things remain the same. So we're looking at 2,400.
Okay, now another big news: ACF released a new product today, value chains for minerals and metals. Why is that important?
So this is a really interesting aspect. We talk about metals and extractives as being a group, but of course, every single one is actually very different. So if you're mining gold, the value chain is different for gold than it is for uranium, for example. Those are two pretty disparate examples, but in between there, they're all actually pretty different. And what we want investors to be able to do is to be able to look at the entire value chain so they themselves can begin to understand where drivers are. And they can also think about how do they cross-read through, but it also gives them a whole load of alternative investments, but within a space that perhaps they feel they understand. So let's say they understand the gold vertical, or they feel they understand gold mining. Then the extension to understand the gold vertical is a lot easier because you can build on your initial knowledge of, say, prospecting, explorers, and mining. And there are listed entities, some of which are very, very interesting. Some perform well when the miners are struggling, and vice versa. So you can keep your knowledge base going, and you could almost think about having a vertical that helps you have your portfolio. So you switch out, say, from miners to another part of the value chain, or back in.
Okay, so your average Joe Blow sitting out there looking at all AI and technology, it's going so great. Why is gold particularly important for investors and capital markets?
Well, it has several uses, and it's a really important indicator to the general health of the world, if you like. So it has its technology uses, sorry, its industrial uses, about 80% of which, in fact, is in tech. So if you have, for example, a slowdown in the production of consumer goods, consumer tech goods, this does actually impact the gold price, and it certainly impacts gold demand. So we had about a 4% fall off in gold demand from consumer electronics last year. So it has that aspect. The other aspect is it's a great signaler for other aspects of the market, so other factors in the market. So, for example, typically when interest rates rise, the value of the dollar rises, and you get a better return on sovereign debt. This makes gold less attractive in theory. We had that environment last year with the higher interest rates for relatively higher than they've been for a very long time. But the gold price still continued to rise throughout the year. Now, some of that rise towards the end of the year, maybe because the markets were pricing in a cut in interest rates. But interestingly, that also then affects ETFs. ETFs will invest less in gold if they think that interest rates are rising. And the long-term trend on central bank buying got reversed a couple of years ago, and they began buying more than the average. So you had all these counter drivers trying to work out where the price was going. And then finally you had inflation, and gold is often still considered very much to be a hedge for inflation, which is probably fair. So it helps you try and identify and focus on what is happening in the markets themselves and what are the real drivers. What gold told us last year was the real driver was geopolitics. Now, the reason we think this is that of all the above ground gold, 46% of it is in jewelry. When you have geopolitical instability, people buy more portable wealth. Diamonds being a great example, but gold is the other big example. So this is perhaps marginal buying, but what it tells you is the market is tight and that marginal buying makes a difference. So that we think the real difference, the real reason the gold hit our target price was to do with geopolitics, driving migration, driving portable purchasing.
Okay, well, in terms of innovation in mining and processing for that matter, what strides has gold made that is unique and comparable to other critical metals?
Well, I'm not sure that it has made particularly unique strides. We have a difference of opinion, and it is expressed in our new thematic. Um, but in my opinion, it hasn't made. I don't think the strides are particularly different to the ones that have been made in other metals, but we do have a different view in the note, which just shows the how analysts can disagree within the house. I don't get to tell them everything. Um, I think the other part of that is that one of the more interesting areas is always the microbial side. So you have gold is particularly good for microbial leaching approaches. And that made a lot of progress and then didn't. And we think that with AI, with techniques from biotech, which allow us to process an entire genetic code very, very fast and very, very cheaply, we think that could well be about to change, that there will be another attempt to innovate on the microbial leaching side, which is got pros and cons from a sustainability point of view, and so it will be trying to address the sustainability part of that equation as well. So for us, it's the kind of bioorganic leaching, which we think has got a chance of taking a big jump forward over the next few years.
Well, Christopher, once again, thank you so much for your time. We're looking forward to hearing all other innovations you have for us coming up next month. But until next time, we look forward to you having a great month.
Scott, thank you very much. We look forward to seeing you again next month.
For everyone else out there, good luck investing.